Hello, my name's Clive Thompson, and the little boy next to me, you might recognize him from the previous video. He's 8 years old, and he's come along with me to learn all about investments and finance and stocks. And today I'm talking about stocks again. I did a video, I talked about price earnings ratio, the PEG ratio, and GARP, which is growth at a reasonable price. And I had some questions like price earnings ratio and PEG ratio, why it's important, but I had questions about how they can find these information easily on websites. Well, there's loads and loads of websites out there which have information on the price earnings ratio, the prospective price earnings ratio, that's what they think it will be next year. It's important not only to know where it was, but where it's going, and the PEG ratio. Most websites also have information on the PEG ratio, and of course the GARP is just an expression I use, growth at a reasonable price, so you won't find any expressions of GARP there, but I've told you how to calculate that. But basically it's the same as the PEG ratio in a certain sense. But the question is, where do you go to get that information? Well, there's loads of places where you'll find it. Obviously a free site is Yahoo Finance. I personally like marketscreener.com, but some people might find that a little bit too overwhelming. And if you want to keep it really simple, there's a website called simplywall.st. It's like Simply Wall Street. That's a great place to go. They've all got free versions. I think you can get all of this information for free. But if you want the paid version, I don't think they're very expensive. I have the paid version for these. There are also sites like Finviz, for example, and Benzinga, and loads of others which have this type of information if you look around. So if you want to know what the PEG ratio or the P ratio, go to some popular finance websites like Yahoo Finance, and you'll find that information if you look around. Typically you'll put in the company name, and then you'll click on fundamentals, and the PE ratio will be there. And if you look around, you'll probably find the PEG ratio too. So today is not about PE ratios or PEG ratios. I'm going to talk about cash flow in companies, and how, if you're aware of what cash flow is, how this can help you pick really good companies, and companies which are going to make a profit. First of all, do you know what a company is?
Yes.
Can you give me an example?
Caterpillar, Thompson, Apple.
What does Caterpillar make?
Tractors.
What does Caterpillar make?
Tractors.
Tractors, yes. And what was the other companies you said?
Apple and Thompson.
Okay, why do you like Apple?
Because they make iPhones and iPads.
Okay, so my little boy's got the idea, but of course it's not enough just to like a company because of their products. You need to have companies which are making profits, and that's where the price earnings ratio will tell you how much profit you're getting for the amount you invest, and the PEG ratio will tell you how much growth you're getting. But what we're going to talk about is cash flow, because when a company makes a profit, there's a question: is that cash in the bank, or is it something else? Now, do you know what a profit is?
Oh yes, a profit is when you buy something and then the price goes up, so you get a profit.
That's right. So in a business, when they buy their goods and they sell them for more, that's a profit. But the question is that turning into cash? So to give you an example, let's say I'm a steel company as an example, and I'm buying my steel for 100, and I usually sell it for 120. So I've got 20% profit. So in normal times, that might be cash in the bank. Buy for 100, sell for 120. I've now got cash in the bank of 20. That's called cash flow. But what if I buy for 100, sell for 120, and then we get a bunch of tariffs on imported steel, and I'm importing my steel. So the next steel I buy is bought at 120. Same price I just sold it for. Have I got a profit? Have I got more money in the bank than I started with? To start with, I had 100, spent it, ended up with nothing but lots of steel. Then I sold the steel, I ended up with 120, I had cash in the bank. And now I spent it again and spent 120 to buy the same amount of steel, and I got no cash in the bank. So actually, although I made a profit of 20 on the last sale, I don't actually have any cash in the bank. So there's a distinction between cash flow and profit. So when you sell something in a business, you want to have cash flow. Now there's many ways and many reasons, many ways to manipulate the cash flow, or not the cash flow, beg your pardon, many ways to manipulate the profit. And in almost every case, in almost every business, the cash flow is actually different from the profit. One of the reasons for that is something called depreciation. It's not the only reason, but let's give you an example. Let's say I own a very large machine, and with that large machine I'm making something, and I'm making, let's say I make, let's say every year it costs me 100, I'm selling for 120, so I'm making 20 of profit. But that's cash in the bank for me. But in this case, my machine is going down in value by 10 every year. So that's called depreciation. So from a profit and loss perspective, that will reduce my profit from 20 down to 10. But I've still got 20 of cash. So I've still got 20 of cash in the bank. I was just waving a car on there and they were stopping because we couldn't decide who was going to go first. Excuse the noise of the cars and the tractor we just walked by. Who makes tractors?
Caterpillar.
Caterpillar. Yeah, that wasn't made by Caterpillar, that one though. Anyway, so I still, if I've got the machine, I'm buying for 100, selling for 120, that's $20 of cash in the bank, but my machine has gone down in value by 10, so my profit is only 10, but the cash flow is 20. Now, in most companies, it's a situation of, with various things going on in the companies, like investments and so forth, they're buying new machines and things. In most companies, you've got a lower cash flow than you have earnings per share. But it's always a good thing if you have more cash flow, because cash, in my mind, is the ultimate arbiter of profit. If you've got cash in the bank, you can spend it. If you haven't got cash in the bank, you have to borrow the money if you want to spend it. So when I'm looking at companies to invest in, one of the things I always look at, apart from looking at their profits, is their cash flow. And if I see they have a lot of profit and no cash flow, or worse, negative cash flow, money's going out of the bank, that's a bad sign for me. On the other hand, if I see a company where they've got a profit, but their cash flow is even higher than their profit, it means they're throwing off a lot of cash. They must be doing something right. So I'm very happy with companies which make a lot of profit. I'm even happier with companies which make a lot of cash flow. So that's my point, and I think we're going to finish the video here. When you are looking at a company, look at the cash flow per share and compare it with the profit per share. Now, one of the factors you can do to improve your returns is mainly invest in companies which are cash flow positive. If they're cash flow positive, they're making positive cash flow above zero, and ideally more cash flow than their reported earnings, then they're going forwards, they're probably paying down their debt, they've got less debt or more cash in the bank, depending which way you look at it. That's a good sign. Whereas if a company's got negative cash flow, that means money is going out of the door despite the fact they're making a profit, and it means they're going to go heavier and heavier into debt. And as we all know, debt can be a bad thing if it becomes unmanageable. In another video, we'll look at something called the debt to equity ratio and the overall debt levels of companies and see how that affects companies. But for the purpose of this video, another metric you need to be looking at as an investment style is high cash flow companies. Certainly if you were going to, speaking to Warren Buffett, he would say, I love companies which are throwing off cash. And he's right. He's absolutely right. You really want to be investing in companies which are throwing off cash, and that's where the cash flow statement comes in. But you don't have to do the hard work of analyzing the company accounts. All you have to do is go to one of the many websites out there which do financial analysis for you, and almost every one of them will have cash flow per share. Now, did you understand everything I said? Have you got any questions?
No.
You sure? You know what cash flow is?
Yes.
Wow, pretty good. You're going to be a little financial genius. You're going to be my investment advisor one of these days. So would you buy a company with high cash flow or low cash flow?
High cash flow.
Okay, you got it. Well done. So there you are. If an 8-year-old can get it, I think you can. And don't forget, if you like this video, if you want to watch more of them, thumbs up, subscribe, and I will try and reply to all your comments. Thank you very much indeed. Bye-bye.